Now, friends, let me take this case study with all of you. This case study I have designed specifically for this particular webinar because I'm aware that today on this webinar we have a good mix of valuation professional belonging to three different assets category. I know some of you do the valuation of land and building, some of you do the valuation of plant and machinery, and few of them perhaps do the valuation of financial assets and the securities. And therefore, your exposure to the discounted cash flow method may not be as much as it would be for someone who is doing the valuation of financial assets and securities. And therefore, I thought, let me make a case study so that every one of you are not only able to understand how the geopolitical risks are to be incorporated into the valuations, but you are also able to understand the process of discounted cash flow method, the valuation process of discounted cash flow method. So, Sudeep ji, are you able to see my screen or your screen?
Yes.
Okay, good. So what I'm showing to you now is the Excel sheet actually, Excel sheet. So you are able to see the Excel sheet, right? Okay.
If possible, after that end of this session, if you share this Excel sheet, that will be useful for.
सुदीप जी कोई परवाह नहीं, डोंट वरी, यू विल गेट इट एक्चुअली, यू विल गेट इट. आप मुझे एक व्हाट्सएप मैसेज भेज दीजिए, मैं आपको पर्सनली भेज दूंगा. तो जिनको भी ये कॉपीज चाहिए वो मुझे व्हाट्सएप मैसेज भेज दें, तो मैं उन सबको पर्सनली आई विल सेंड इट टू देम, बिकॉज सी दीज आर माई IPRs and I do not want to put them into public domain, so I would like to give it to them only to those who are really interested. Therefore,
I'll send you a mail because your email is visible here.
Sure. You can please send me a mail. That is also okay. Mail or WhatsApp, whichever way is convenient. Okay.
So even PPT, total PPT is available a little bit, right, sir?
Send me a WhatsApp message. I will share with you my number and then I'll share it with you. No issues. I want to send it to only those who are really interested. I do not want to. मुझे हलवा नहीं है ये कि सबको बांटूं. ये डायमंड है. ये डायमंड है. ये डायमंड है. हर किसी को नहीं दे सकता. हलवा होता सबको बांट दूंगा मैं एक्चुअली. तो ठीक है. ओके. सो राइट. सो लेट्स कम बैक. अब मैं आपको what I'm discussing with you now is what I'm explaining to you now is number one, discounted cash flow method, how to do the evaluation using the discounted cash flow method, and number two, what is also I'm discussing with you, how to incorporate the geopolitical risk into your business valuations. So what I have for you, assumptions. So what the assumptions are, number one, I am taking base discount rate as 10%. Then I am assuming tax rate of 30%, terminal growth rate of 3%, and I am assuming that every year the capital expenditure will be increasing by 50 crore or whatever that amount is. The denomination is not important. You call it crore, millions, billions, whatever. So for the sake of simplicity and saving time, I'm just saying 50. So your capital expenditure is going to increase by 50 every year. Your working capital is going to increase by 20 every year. Because for the purpose of discounted cash flow method, please remember what we have to do. We have to prepare the projected cash flow statement. And for preparing the projected cash flow statement, we have to also prepare the projected profit and loss statement. So these assumptions that I have just mentioned to you are for the purpose of making the profit and loss statement, and then these assumptions will also be used for the purpose of preparing the cash flow statement, and that cash flow statement, that projected cash flow statement, will be used for the purpose of arriving at the valuation, and after that we will do the analysis as to how to factor the geopolitical risks into this valuation, right? So उसके अलावा आई एम अज्यूमिंग कि जो मेरा डोमेस्टिक सेल्स है वो 10% से बढ़ेगा हर साल. I'm also assuming that my export sales will be increasing by 20% every year. I'm assuming that my cost of goods sold is going to be 40% of total revenue. And I'm also assuming that my operating expenses will be increasing by 12%. So these are the assumptions that I have taken for the purpose of this discounted cash flow method valuation, right? Okay. This is what I will come to in the second part, this one. So these are the assumptions, scenarios. So scenario number one is there is a stable environment. Scenario number two is there is a trade war. So if there is a trade war, what are the assumptions, or what are the analysis perception that the domestic revenue growth will drop by 3%, and the country risk premium will increase by 1.5, will be 1.5%. The third scenario that we are talking about is that another country, let's say US, has imposed sanctions. So what will happen if the US imposes these sanctions? So export revenue will drop. Let's say in this example that we are discussing, the export from the revenue will drop by 20%, and the discount rate will increase by 2%, will be increased by 2%. The fourth scenario that we are discussing is conflict zone. So let's say the country that we are talking about is in a conflict zone. So in case of a conflict zone, the capital expenditure we will assume will increase by 25%. So 50% is what it is supposed to be increasing. So it will not increase by 50%, it will increase by 50 into 1.25. The working capital will be increasing by 30%, and the discount rate will be plus 3%. So whatever is the base rate that we have taken, it will increase by 3%. So these, friends, are the assumptions that we are taking for the purpose of making the profit and loss statement and for the purpose of making the cash flow statement, and then we will do the valuation together. So if you have any question on these assumptions, please go ahead, else I will go to the preparation of the projected cash flow statement. Anyone, please feel free. Anyone, any question, any doubt about the assumptions that I have shared with you. Okay, so let's come to the projected cash flow statement. Now what I am doing is I am doing the projected cash flow statement. So how do I do the projected cash flow statement? तो जो पहला साल है, पहले साल का जो मेरा डोमेस्टिक सेल्स है दैट इज 500, एंड सेकेंड ईयर का जो है, अगर मैंने आपको बताया my domestic sales is increasing by 10%. So you can see my second year domestic sales is increased to 550. My third year is increased by 2605. Fourth year has become 6.666, and the fifth year has become 732. So this is how I have projected my sales, domestic sales, for next 5 years. What about the exports? I have told you that my exports are increasing by 20% every year. So for the first year, my export sales was 750. It has increased by 20%. So that means it has become 900 in the second year. In the third year, it has become 1080. Fourth year, it has become 1296. Fifth year, it has become 1555. So this is how my sales has progressed. I did mention to you that my COGS, my cost of goods sold, is 40% of my total revenue. So मेरा जो total revenue है उसका 40% is my COGS. So my COGS is 40%. So year 1 में my total revenue was 1250. 40% of 1250 is 500, and that is how my COGS is coming. And this is how the figure of COGS, cost of goods sold, have undergone a change over the next 5 years. How do I get my gross profit? Very simple, we all know. So total revenue minus the COGS, what I get in my hand is my gross profit. Now from the gross profit, what I do? From the gross profit, I minus my operating expenses. My operating expenses, I have told you, are increasing by 12% every year. So the operating expense for the first year is 400. and this is increasing by 12% every year. So in the second year it has become 448, and in the final year, fifth year, it has become 629. No rocket science. I am sure it is clear to everyone. So what is my EBITDA? How do I get my EBITDA? My EBITDA is gross profit minus my operating expenses, and that is what is my EBITDA. So this is my EBITDA. EBITDA का मतलब ये है कि ग्रॉस प्रॉफिट में से जब मैं मेरे ऑपरेटिंग एक्सपेंसेस को माइनस करता हूँ, तो व्हाट आई गेट इन माय हैंड इज माय EBITDA. EBITDA में से मैं मेरा डेप्रिसिएशन माइनस करूंगा. तो मेरा हाउ डू आई गेट माय डेप्रिसिएशन? सो दिस इज हाउ आई विल गेट माय डेप्रिसिएशन. सो यू कैन सी हियर, दिस इज माय डेप्रिसिएशन कंप्यूटेशन. सो पहले साल में मेरे पास में 500 का एसेट्स है और 0 एडिशन है, तो क्लोजिंग ग्रॉस ब्लॉक कितना हो गया? 500 हो गया. और मेरा रेट ऑफ डेप्रिसिएशन 10% है, तो पहले साल का मेरा डेप्रिसिएशन 50 हो गया. दूसरे साल में मैंने 50 का और एसेट्स का एडिशन किया, मेरा ग्रॉस ब्लॉक 550 हो गया. सेकेंड ईयर का मेरा डेप्रिसिएशन 55 हो गया. एंड लाइक दैट माय डेप्रिसिएशन for the last year it has become 70, right? 70. So what I have done is, ये जो नंबर है डेप्रिसिएशन के जो मैंने यहाँ कैलकुलेट किए हैं, मैं ये नंबर को ऊपर में लेके जाता हूँ, और दिस इज हाउ व्हाट आई हैव डन. आई हैव टेकन दीज नंबर्स फ्रॉम हियर. तो मैं ये नंबर नीचे से ले लिए. सो दिस गिव्स मी माय EBITDA. सो फ्रॉम the EBITDA I will minus my depreciation, and what I get is my EBIT. Friends, by the way, for your information, EBITDA is also known as cash operating profit. EBIT is also known as operating profit. Meaning what? Meaning if someone is saying EBITDA, that means he is also referring cash operating profit. If someone is saying EBIT, that means he is also referring operating profit. Now from the operating profit, what I do, I deduct the finance cost. And how do I get my finance cost? Again, I have done the working of my finance cost. So I have taken my working capital here. So this is my working capital, which is increasing by 20. This is my closing working capital. So I am assuming that on an average 70% of my working capital is utilized in a year on an average. So therefore the amount on which I will need to pay interest is this 210 or 224, and on this average utilization I apply the rate of interest and I get the finance cost. So this is the finance cost that I have taken here. This is the finance cost that I have taken here. Finance cost here, and so from the EBIT I have minus the finance cost. What I have got in my hand is the EBT. एंड EBT के ऊपर मैंने 30% टैक्स माइनस किया. सुदीप जी कुछ कहना चाह रहे हैं आप?
No, sorry.
Okay.
Sorry.
Okay. No problem. From the EBT, I will minus the tax, and what I get my EAT, that is my earning after tax. So this is how I will calculate my projected profitability statement. This is a very simple vanilla model for calculating the projected profitability to help you understand it very easily, and then you can build on it as you move forward. So having done the projected profitability statement, now what do? I make my cash flow statement, right? This is my cash flow statement for the purpose of equity value computation, for finding out the equity value. So what I have done is, this is my EAT, and I'm sure all of you know where it is coming from. It is coming from my P&L, right? So maybe what I can do, I can remove these numbers. I can remove these numbers so that you get an idea as to where these numbers are coming from. So I would be able to give you an idea as to how these numbers are coming, right? So what I do, what is my cash flow? My cash flow is earning after tax. What I have to find out is free cash flow. So how do I find out the free cash flow? Free cash flow is EAT plus depreciation minus capex minus increase in working capital. That is what is my, this is what will give me my free cash flow. So EAT, so what I do, I put here equal sign and go here, and I have imported my EAT, and I just drag it to the remaining 4 years. So I have got my EAT coming in. Right, and then what I do, then I take the depreciation. So where do I go for the depreciation? Here I come to the depreciation. I have taken the depreciation, and again I have to drag it for the remaining 4 years, and I get my depreciation here. So this is my total cash flow. This is my total cash flow for the respective years. Now this is my total cash flow. Please remember, all of you, my total cash flow is not my free cash flow. So what is free cash flow? Free cash flow is the cash flow which is in my hand, which I can use freely, So this 245 is not my free cash flow. It is my total cash flow. So why it is not my free cash flow? Because I have incurred certain capital expenditure. So if I have incurred certain capital expenditure, that means so much of the cash I have consumed already. So I did the capital expenditure of 50. So that means 50 is I have already eaten. So that 50 is not available with me. Likewise, my working capital has increased by 20. So which means this 20 is also gone. It is also not available with me. So these are the cash flows which have gone from my hand already. तो अब जो बचा, that is what is going to be my free cash flow. I'm sure all of you are very clear. Sudeep ji, does it make sense to you? Mahendra ji, does it make sense to you? Please confirm.
Yes, very clear.
Okay, very good. Okay, so now what I have done is, now I will have to use my discount factor. So again, I am going to rub it off so that I am going to show it to you as to how did I arrive at this figure. Actually, I should have done it before, but no problem. So how do I get my discount factor? I am sure you will remember the base discount rate is 10%. That means equal sign 1 divided by 1.10. Now this is my discount factor for the first year. How do I get my discount factor for the second year? So the discount factor of the first year divided again by 1.1, and this is my discount factor for the second year. I do not have to calculate it for the third and the fourth year and the fifth year. I just need to drag it, and it automatically gives me my discount factor for all the 5 years. Now, how do I get my present value of free cash flow? So what I need to do is, I just need to, this is my free cash flow and this is my discount factor. So I multiply both of them, and then this is my present value of future cash flow for year 1. And when I drag it, I get my total present value of free cash flows for the explicit forecast period. So ये जो 5 साल है, these 5 years are referred as explicit forecast period. Now I have also got the present value of the terminal period calculated. So the terminal period is also calculated, and when I total them, so this is my present value for the forecast period, and this is my present value for the terminal period. Now for the benefit of some of you, but I am sure all of you must be aware as to what is terminal value or terminal period. So remember, when you are using the discounted cash flow method for the purpose of valuation, what you are doing, you are finding out the cash flow of all the years. Now please remember, it is not possible for anyone to calculate the cash flow for all the years to come. Why? Because companies start for infinity. and it's just impossible to find out the cash flow for the infinity, because you cannot put all the years, because it's infinity. So therefore, what we do, we use something which is known as two-stage discounting model. Two-stage discounting model. So what these two stages are? These two stages are: number one, explicit forecast period. So this 5 years cash flow that we have made, the 5-year P&L that we have made, that is your explicit forecast period. So what is this explicit forecast period? This explicit forecast period is also supposed to be the period when the company will have a abnormal growth, super high growth. So that is the period which is known as explicit forecast period. What is the terminal period? Terminal period starts where the explicit forecast period ends. So in our case, the explicit forecast period is ending at the end of the 5th year, and from the end of the 5th year, the terminal period is starting. And why do we have this two-stage discounting model? Because when you calculate the cash flow of the terminal period, for which there is a model, there's a formula. I'm going to discuss that with you. So when you cannot calculate the cash flow for the infinity, but you can calculate the cash flow for the terminal period. That means period which is after the end of the explicit forecast period. So when you calculate the cash flow for the terminal period, you find out the present value of this cash flow, which is for the terminal period. And now you do the total of the present value for the explicit forecast period, present value for the terminal period. When you add them together, what you get in your hand is the equity value of that business. You divide this equity value of the business by the number of shares, you will get the value per share. Okay. So I'm now going to explain to you how to find out the terminal value, present value of terminal period. So what you have to do is you take the cash flow of the last year, and this is your free cash flow for the last 450 is the free cash flow for the last year. तो आप क्या करिए, आप जो लास्ट ईयर है उसका जो फ्री कैश फ्लो उसको लीजिए, और वो जो फ्री कैश फ्लो है 452 into 1.03. So what is 03? I'm sure you would remember. I had told you 03. This is the terminal growth rate. So what you do? You take the cash flow of the last year, multiply it with 1.03, and this will give you the cash flow starting of the terminal period. And then what you do, divided it by the discount rate, which is 1.0 here, minus the growth rate during the terminal period. So this will give you the free cash flow for the terminal period. And once you do this, then you divide this, so let's say you get the free cash flow for terminal period. Now you discount it. You discount it by what? You discounted it by the discount factor, which is 0.683. So last year का जो discount factor है उससे आप उसको discount करिए, and that will give you your equity value. So this is what you have got, present value of terminal period, which is, and then put this into, I'm just trying to make it happen for you. This is your total present value. This is the free cash flow, free cash flow for terminal period, and I'm just going to insert one more row here. So one row here, entire row, and here I'm going to write is present value of FCF for terminal period, right? So now what I need to do is, this is the free cash flow, and discount it by the discount factor of the last year, and this becomes, sorry, it should be multiplied, and total equity value is total of this, which is present value of free cash flow during the explicit forecast period, and the present value for the cash flow of the terminal period, and this is how you get 5,288 as your equity value. So let me throw it open to every one of you. Sudeep ji, Mahendra ji, if you have any question, please ask me before I move to the next step.
No, it is clear.
Mahendra ji?
Here we are calculating total equity value, not EPS.
Not EPS. It won't be EPS. It will be equity. It will be value per share.
Yes.
Equity value. EPS is dividing the profit after tax. Yes, Mahendra ji, please go ahead. Mahendra ji. Okay. Right. So let me now come to how to factor the geopolitical developments into your valuation. So Sudeep ji, as you can see, we have done the valuation, which is a base case valuation. Now, how to incorporate the risk? So we'll just take one example, because just 5 minutes are remaining, and remaining I'm sure all of you can work out independently. Okay, so trade war कर लेते हैं हम. तो domestic revenue will drop to 3%. Okay, so domestic revenue drops to 3%. Growth drops to 3%. So we have assumed the growth to be 10% in case of domestic, 20% in case of exports. Export पे फर्क नहीं पड़ रहा है, फर्क पड़ रहा है खाली domestic पे. So we will reduce the growth rate by 7%. Okay, because it is dropping to 3%. And CRP we will add 1.5%, right? So let me come here. So this is the profitability that we have. So as you can see, we had assumed increase of 10%, and it is, the case is saying it is dropping to 3%. The growth rate is dropping to 3%. So therefore, I will
1.07.
Yes, 1.03, because
07, sir.
No. देखिए, ये जो assumption है, it says growth drops to 3%.
Drops to 3, okay.
Not by 3%.
Okay.
To 3%. So this is going to increase by only 1.03. And what I do, I simply drag it. Now, before I do that, please note here, you can see the equity value here. Did you notice that? This is the equity value we have calculated, 5288. Everyone, 5288. And you can see this equity value of 5288 appearing here also. Now just see the magic. So what I am doing is I am incorporating the first factor, and I am just increasing it by 0.03. You can see my equity value has gone down. And as I do it further, you can see my equity value has further gone down. So this is the impact that decrease in the growth rate has on my valuation. So that is one factor which is given here. The other factor which is given here is the CRP adds 1.5%. So meaning what? Meaning we come to here the cash flow projections. Now in my computation here of discounting factor, I have taken it as I have taken that discount factor is 10%.
Yes.
The case is saying it is increasing by 1.5%. So CRP, the country risk premium is 1.5%. So which means now what I need to do is I need to increase it by 1.5. So it becomes 1.115. And just watch the figure of, you can see this here 4525, and just watch the change in the valuation. You can see it has gone down to 4464. Now again, remember, this change is not for 1 year, this change is for the entire period. So which means what? Which means I have to change it here also actually. So मैंने किया, and you can see the value has again gone down, and I would drag it, and you can see the value has again gone down, right? So this is how you can see the risk of geopolitical developments needs to be factored into, right? So now this is exactly 6 o'clock in my watch, and with this I also come to the close of my presentation, my discussion. So in case if you have any question, you can please ask me, and I would be happy to take them. Thank you so much. Thank you.